I want to ask you about some of the criticisms that you hear and we all hear about the policies that the Fed has employed over the last few years and other central banks are now employing. The ECB is looking at QE. There's a feeling, I think, in this room and outside the Fed that there are concerns that the QE programs, for instance, have potentially stoked bubbles, asset bubbles in financial markets, that they've taken governments off the hook for putting through difficult structural reforms, addressing long-run deficit issues. How do you respond to those two criticisms in particular? One, that the central banks are stoking bubbles around the world, and that they're taking other policymakers off the hook.
Let me start with a second. We have a very clear mandate set out in the law. The law is that we should use the monetary policy tools to achieve maximum sustainable employment and stable prices. We cannot be in a position of saying, well, we won't do what we could do unless you, the politicians, do something. That is wholly inappropriate. We've given a message, we've been given tools, we have to use them to try and achieve the goals that have been set. So this taking the governments off the hook would put the Fed in a really difficult position of saying to governments around the world, well, yes, we could do that, but we're not going to do it until you do the other, whatever the other thing is. You know, much rather they did more infrastructure investment, for example. But if they don't do it, I don't see that we have any right, according to the law, to say, well, because you're not doing that, we're going to reduce the growth rate relative to what it could be. That's a political game that we should be very far from getting into. So I don't buy that part at all. The bubbles question is more complicated. In an economy in which the financial system is whole and sound, operating with a zero interest rate is likely to produce pressure on asset prices, taking them close to possibly bubble proportions. I had to deal with that in the Bank of Israel because the financial system withstood the crisis without any problems. In countries where the financial system is broken, as it was in the United States in 2008, 2009, you do not necessarily create bubbles, and in particular, I don't think anyone thinks we've got a real estate bubble in the United States. If you look at the financial difficulties that lead to crises, financial crises, they typically involve real estate and construction. There are other times. There was, of course, the high-tech bubble a few years ago, at the turn of the century. But basically, it's real estate. We're very far from that. There are a few local areas where risk premia are lower than you would like to see them, but I don't see an overall problem of that sort. So I think what's been done is that those countries with healthy financial systems, Norway, Hong Kong, Singapore, Israel as well, and there are another 10, 12, have had troubles with Australia, have had trouble with real estate prices that are very high and frequently rising. Other countries which are in the crisis haven't had to deal with that problem because the financial system isn't doing what it would normally do.
Well, in the United States, we're seeing booms in leveraged loans, junk bonds, other asset classes. Doesn't that worry you?
Look, we can't sit around judging every single asset price and deciding this one the Fed will deal with rather than let the market deal with it, and that one we'll deal with. You've got to leave the markets basically to do their thing, and for us to make an overall judgment on the overall level of what's going on. If we see a crisis that looks like a bubble or a boom in a sector that looks like it will have major consequences for the whole economy, we need to intervene. If it's something which the market should be correcting, the market should correct it.